Mastering Mutual Funds, a comprehensive guide for Indian investors. Hello, aspiring investors. Welcome to our channel. Today, we're diving deep into the world of mutual funds in India. Whether you're a novice looking to start your investment journey or an experienced investor seeking insights, this comprehensive guide will equip you with the knowledge you need. Let's get started. What are mutual funds? Let's start with the basics. What exactly are mutual funds? Mutual funds in India are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. Types of mutual funds in India. Mutual funds in India come in various types to cater to different investor needs and risk appetites. Let's discuss some of the most common ones. Equity funds. These funds primarily invest in stocks. An example is the Reliance Small Cap Fund, which predominantly invests in smaller companies with the potential for significant growth. Debt funds. Debt funds invest in fixed income securities like bonds and government securities. An example is the ICICI Prudential Corporate Bond Fund, which focuses on corporate bonds. Hybrid funds. These funds combine both equity and debt investments to provide a balanced approach. An example is the HDFC Hybrid Equity Fund, which allocates its assets between stocks and bonds. Index funds. Index funds aim to replicate the performance of a specific stock market index, like the Nifty 50 or Sensex. An example is the UTI Nifty Index Fund, which mirrors the Nifty 50 index. Tax-saving ELSS funds. Equity-linked savings schemes, ELSS, offer tax of the Income Tax Act. An example is the Axis Long-Term Equity Fund, known for both tax-saving benefits and potential capital appreciation. Benefits of investing in mutual funds. Investing in mutual funds in India offers several advantages that make them attractive to investors. Diversification. Mutual funds pool money from multiple investors and invest in a diversified portfolio of securities. This diversification helps spread risk. For example, if one stock underperforms, the impact on the overall portfolio is minimized. Professional management. Mutual funds are managed by experienced fund managers who make investment decisions. These professionals analyze market trends, select securities to achieve the fund's objectives. Liquidity. Mutual funds are highly liquid. Investors can redeem their units on any business, providing access to their investments when needed. Affordability. Mutual funds allow investors to participate in various asset classes, relatively small investments. This makes them accessible to a wide range of individuals. Risks involved in mutual funds. While mutual funds offer many benefits, it's essential to be aware of the risks associated with them. Market risks. The value of investments in equity funds can fluctuate significantly due to market conditions. For example, during a market downturn, the net asset value, NAV, an equity fund may decrease. Credit risks. Debt funds are subject to credit risks if the issuers of the bonds held by the fund default on interest or principal payments. Liquidity risks. Some mutual funds may invest in less liquid assets. If many investors want to redeem their units simultaneously, the fund may face liquidity issues. Interest rate risks. Debt funds are sensitive to changes in interest rates. When interest rates rise, bond prices fall, impacting the NAV of debt funds. Taxation of mutual funds. The tax treatment of mutual funds in India depends on factors like the type of fund and the holding period. Equity funds. Gains from equity mutual funds held for over 1 year are considered long-term and are tax-free. Gains from those held for less than a year are subject to a 15% short-term capital gains tax. Debt funds. Long-term gains from debt funds held for more than 3 years are taxed at 20% with indexation benefits. Short-term gains are added to the investor's taxable ELSS funds. ELSS funds offer tax benefits under Section 80C. 1.5 Indian rupees lakh are deductible from tax. Tips for mutual fund investors. Before you start investing in mutual funds in India, consider these essential tips. Set clear goals. Define your financial goals, whether it's buying a house, funding education, or building retirement savings. Risk tolerance. Assess your risk tolerance to choose funds that align with your comfort level. Regular review. Regularly review your mutual fund portfolio and make adjustments as needed to stay on track with your goals. Systematic investment. Consider systematic investment plans. Case study. The power of systematic investment plan, SI. Let's take a real-life example to illustrate the benefits of SIPs. Imagine Mr. Patel, who starts investing 5,000 Indian rupees per month in an equity mutual fund through SIP. Over time, he benefits from rupee cost averaging. When markets are low, he gets more units for his investment, and when markets are high, he buys fewer units. Years later, he finds that his investments have grown substantially, thanks to the power of compounding and disciplined investing. Conclusion. In conclusion, mutual funds in India offer a range of benefits, making them an excellent choice for investors looking to achieve their financial goals. However, it's crucial to understand the associated risks and invest wisely. Happy closing. Thank you for joining us in this exploration of mutual funds in India. If you found this video informative, don't forget to like, subscribe, and share it with fellow investors. Stay tuned for more value. Disclaimer. Please note that this video is for informational purposes only and should not be considered financial advice. Mutual fund investments carry risks, and it's essential to do your research and consult with a qualified financial advisor before making any investment decisions.